Relevant cost and income, actually, you can call it relevant cash flows. So while doing project appraisal, we need to, like we said, that we would consider that if you make an investment, how much is your investment, which is called cash outflow, and then in return, how much you will receive cash inflows, which are called relevant cash inflows. So an entity might have a lot of cash flows, but what we need to consider in investment appraisal or in project appraisal, we would actually consider only those cash flows which are directly impacted by the decision of this investment. So it's not about all of the cash flows which an entity makes. We have to make sure that we make our analysis or we make our evaluation process based on those cash flows which arise as a result of taking that decision, and that is called relevant cash flows. And the concept goes back to some of your, if you have taken a management accounting course in past, you might be familiar with the concept of relevant costs, if you remember too. If you remember that, we said relevant costs are those costs which are impacted by a decision, and that includes the opportunity cost as well. So similarly here, we have to see the opportunity cost as well. It's very important point to begin in any investment appraisal decision, because when you do investment appraisal, you will have cash flows, incoming inflows and cash outflows, and you need to make sure that you do not include some non-relevant cash flows. You only and only have to consider the relevant cash flows. So this is the starting point. So first we collect the relevant cash flows, cash inflows and cash outflows from the investment decision, and then we do our evaluation. So let's see what it is included. It says cost or income that are relevant to investment appraisal are easy to identify. Simply ask what cash flows are changed by the decision, So amounts are relevant if only they are future incremental cash flows. So always remember it has to be future, because any past cash flows are not relevant. They have to be incremental, which means additional, and it has to be in form of cash. So future incremental cash flows are called relevant cash flows. Now, some of them will be cash outflows, some of them will be cash inflows, but they have to be future incremental cash flows. Examples of non-relevant cost: what cash flows are changed by the decision, and we exclude sunk or past cost. So sunk costs or past costs are not relevant. This is the same concept we learned in management accounting basics, okay? Sunk cost or past costs are not relevant. I mean, this is the money which you already have spent in past before you take the decision. I give you an example. Let's suppose we are planning to invest in a certain product, and for making that or taking that decision, we do some research. Either we should go with option A or we should go for option B. We do some analysis, we do some workings, and we spend some money on collecting this information. And now this information is with us, and we have to take a decision whether we should go for A or we should go for option B. Now, the money which you already have spent is not relevant, because this money you have already spent before the decision. Now, whether you spent A or you spent B, you cannot make any change in the past. I mean, those cash flows or that money you already have spent. So any past costs are never relevant. We say that they have to be future cost, future incremental cash flows. So now you've got two options, option A and option B, and you say, okay, I'm going with option B. You go with option B. Now, after when you say that I'm going with option B, so any other cash flow which you incur after this point, that is going to be relevant. What you spent before, which is past, is not relevant. Book values, like depreciation, we call it depreciation, or some other expenditures are not relevant because they are not cash flows at all. Reapportionment of existing fixed cost. This is not possible actually. Sometimes in real life, as well as in exam questions, you will see it. For example, you have a company and you already have some overheads of, say, I don't know, $30,000, and you are starting a new project. And you say, because I'm starting a new project, so some of my existing overhead, I can allocate it to the new project. So I can say that out of 30,000, 5,000 overhead, I will write down as an expense for the new project. This is not allowed and this is not correct, because whether you do that project or you do not do that project, this 30,000 you were already incurring. Yes, if after starting the project, your overhead becomes from 30 to 32, then that additional 2,000, which resulted as which increased as a result of taking the decision, that 2,000 is relevant. Otherwise, whether you do the project or you don't do the project, you were already paying your $30,000 overhead. So we have to only see the change in the cash flows as a result of taking the decision. So reapportionment of existing overheads is not allowed because they already exist. Okay, these are not new. Yes, if there is a change in overheads, that change is relevant. Depreciation is not a cash flow. Committed costs are not relevant. Committed cost means those costs which you already have promised. So whether you do this project or you don't do that project, those costs you already have committed. You already are under a contract with someone. Maybe it's a service contract, maybe it's a lease contract, I don't know. But those costs you already have committed. So those are not due to this particular investment decision. In a very simple line, like the bottom line is that you have to think, is this cash flow or is there a change in the cash flow as a result of this decision? So any cash flows which arise after you take decision are called relevant cash flows. So considering that definition in your mind, these ones are irrelevant or non-relevant cash flows. So it means that if there is any amount which belongs to these items which I've mentioned here, you will not include in your calculation of investment appraisal decisions. Then we say that what cash flows are changed by the decision, which means the relevant ones. So it include incremental cash flows like additional money spent or earned because of the decision. Additional money spent means you might purchase some equipment, some assets, or you may earn some additional cash flow or additional money because of the decision. Opportunity costs. Cash is not received or paid because of the decision, but they are relevant. I give you an example here, which exactly is a very typical academic example. Let's suppose that you have a piece of land, and the value of the land is $100,000. You can sell it today for 100,000. You have an option to sell the land today for 100,000. And then you decide that, okay, I'm not selling the land, but I will build up some apartments on this piece of land. And this is an investment decision of construction of apartments. And the cost of construction of apartment is $500,000. So you are going to invest or spend $500,000 cash out of your pocket. But the relevant cash flow for this particular investment is 600,000. 500,000 is the money which you are going to spend, and $100,000 is the opportunity cost. It is the money which you have foregone, which you are not going to receive because of this decision. Because if you do not make these apartments, what you would have done, you could have sold this land and you could have received $100,000. So instead of receiving 100,000, you are actually investing 500K. So the total amount, the total impact on your cash flow is 600K. I'm sitting here, I already have 1 million with me. If I sold the land, my cash flow would have become 1.1 million. If I sold the land, I've got 1 million in my bank. If I sold the land, I would have 1.1 million in my bank account. But now I don't sell the land, so I don't get 100,000. My bank account remains as at 1 million. And from that 1 million, I take out 500,000, 500,000 and do the construction. So my bank account goes down to 500,000. So as a result of taking the decision, now my bank account is $500,000, 500,000. Otherwise, it would have been 1.1 million. 1 million my own cash plus 100,000 the value of the land. So 600,000 opportunity cost. Now this land is actually the opportunity cost, which you are incurring here in this example. Working capital, for example, cash invested in inventory, it is a relevant cash flow because you start a new project. Not only you will buy some non-current assets, but you will also buy some inventories. So again, cash goes out and that is relevant. Tax is also relevant cash flow. So you will generate some income and you will have to pay some additional taxes, and the tax on that profits, that is a relevant cash flow. These are actually some of the examples. As we will continue doing more questions and doing more discussions in detail, there will be many, many more names coming in, examples. These are just some of the examples of relevant cash flows. We do some question. A company has paid $50,000 to acquire patent rights, has paid $50,000. You already have paid. A factory to make the product would cost 1 million and produce net income of 150,000 per annum. PA means per annum for 10 years. So I already have paid $50,000 for a patent. If I put 1 million to make some production facility, it is going to give me $150,000 for the next 10 years. This is after depreciation of machinery of $30,000 per annum has been charged. So you are making an income of 150,000. And this income is after deducting the depreciation, which was non-cash expense. The factory could be sold at the end of 10 years for $200,000. What are the relevant costs when deciding whether to accept the factory project or not? So we are not going to do appraise this thing whether we should do it or not, but first we see what are the cash flows which we need to consider. Okay, so answer should go like this. $50,000, this is not relevant. It is a sunk cost because you already have paid it. If you see, pay attention to the language, it says a company has paid 50,000. It does not say that you will pay it after taking the decision. You already have paid this money. Now, whether you make the factory or you don't make the factory, this money is gone. So this 50,000 is not relevant for taking the decision. Decision does not depend on this money. This is gone already. Now you make the factory or you don't make the factory, you can't do anything about this cash flow. It has already gone. So it is not relevant. So number one, patent is not relevant. A factory to make the product would cost 1 million. This is relevant because if you decide, yes, I am going to make, you have to give this money. Produce net income of 150,000. This is net income. This is not cash flow. And this net income has been calculated after deducting the depreciation. Remember, you deduct depreciation and then you come to net profit. But depreciation, you did not give out to someone cash. Depreciation is a non-cash expense. So your actual cash flow, your income might be 150, but your cash flow is 180,000. You add back the depreciation. Okay, you say 150 my net income plus add back depreciation 30K, cash flow was 180K. This is an important concept from financial reporting. This is a concept you might have learned in financial accounting and financial reporting. When you make cash flow statement, you add back the depreciation. And the logic is that when I say my profit or my income is 150 after deducting the depreciation, depreciation is a non-cash expense. Rent I pay out, salaries I pay out, but depreciation I do not pay out. So the expense of depreciation 30,000 is there, but cash remains in the business. So this cash is available with the company. And that's why my cash flow is 180,000. And the factory could be sold at the end of 10 years for 200,000. This is also a relevant cash flow because this is incremental. So you need to, when you see a situation, you see, okay, which one are relevant, which one are not relevant. This is always the starting point. We do one more question. A company bought land for 1 million 5 years ago, and this was revalued to 2 million 2 years ago. So 5 years ago, we bought it for 1 million. Now the value of the land is 2 million. It could be sold for 2.5 million. If we try to sell it, now it is 2.5, or the company could build some apartments for $5 million that could be rented for 200,000 per annum for 25 years. At the end of the time, the land and apartments could be sold for 10 million. Now, what are the relevant cash flows? Number one, land. I don't have to buy it now, but if I sell it, I could have generated, or I could generate 2.5 million. So if I say I'm not going to sell it, I want to make apartments here, I am actually foregoing this 2.5 million. So this is as a result of taking the decision, yes, I will make apartments. this 2.5 million cash flow I have to, forego. So it is like a kind of outflow from me. I'm leaving it. Otherwise, I would have received it. 2.5 million. It was purchased for 1 million. It is irrelevant. It was revalued to 2 million. It is irrelevant. What is important? How much it could be sold today? 2.5. This is relevant. $5 million is relevant because that is going to be expense construction. Rent 200,000 per annum is relevant, and to $10 million residue, I mean the disposal value after 25 years, this is also relevant. So we make it like this. You would say that 2.5 million is an opportunity cost. So this is relevant. So we say that this 2.5 million is relevant. This is relevant. 200,000, 10 million is relevant. So the first step is that you identify that the cash flows which are given to you, which one of those are relevant and which are not relevant. And of course, the relevant cash flows are the one which we will use in our calculation for investment appraisal. Another question is here, quite a lot of things coming up. A new machine costs 100,000 and it would generate revenue of 320. Material A is in inventory and costs 50,000. The company has no other use for it and it could be sold for 30,000. Material B is used regularly by the company and is in inventory at a cost of 20,000. It could be sold for 10,000 and its current replacement cost is 25,000. This is replacement cost of material, again, a management accounting concept, but we use it here as well. The machine would increase insurance cost by $3,000 and it would be charged 5% of the current factory rent of 50,000. What are the relevant costs? Let's start doing like this, okay? So machine, if you purchase the machine, it would increase your insurance cost by 3,000. This is relevant because this is a cost which would be incurred as a result of taking the decision. It would be charged 5% of the current factory rent. This is not relevant because this is a rent we are already paying. Remember, existing overheads cannot be charged to the new project. Machine would cost 100,000. This is relevant. It would generate revenue of 320. This is relevant. Material A is already in the inventory. You purchased it for 50. The company has no other use for it, and it could be sold for 30,000. So either you use this material in this project or you sell it out. If you sell it out, you will sell it out for 30,000. So 30,000 is relevant. We purchased it for 50,000, but that is past cost. Past costs are not relevant. 50,000 we paid sometime in past before this decision. This is not relevant. Yes, if I purchase this machinery and I say, okay, I'm using this material, so it means that 30,000, which otherwise I could have generated by selling this material to someone outside, I could have generated 30,000. This is the value current. I say, okay, I'm not selling it, I'm using it. So I'm actually foregoing 30,000. This is opportunity cost and that should be added. Material B, it is a second type of material, is used regularly, this is important, by the company, and is in inventory at cost 20,000. So we purchase second type of material B for $20,000 in past. So this is not relevant. It could be sold for 10,000. In market, it could be sold for 10,000 and its current replacement cost is 25,000. So here I will take 25,000. Although it could be sold for 10,000, but thing is that I'm using it regularly. Why would I sell it in the market to someone for 10,000? If I take it from my inventory, I have to replace it because I use it regularly. So if I have to use it regularly, I need to buy it from the market and the market is 25. So 25 is relevant. So what we understand here, this material thing, I will come back again and explain you again, because I know there are some students might be getting some confusion. This is relevant 100K. This is 320 is relevant. Here, this 30,000 material is relevant. This 25 is relevant. This 3,000 is relevant and this is not relevant. Okay, this is the answer. Now coming back to the material thing. You have two types of material. If you come back and see here, material A, if I talk about, its cost was Okay, why would I write down here? It's already here. Material A, the cost was 50,000. Whenever it says that something it cost you 5,000, 50,000, 5 million, you will always cancel it out. Cost is never relevant because this is something which happened in past before this decision. And anything which is and past costs are not relevant cost. So I don't care whether you bought it for 5,000 or 50,000. It was before the decision. So just ignore it. What can happen now? What can happen now that I have no other use for it? I have no other use for it. So what is the best option? What best I can do with this material? I can sell it out and I can generate 30,000. So 30,000 is my relevant cost. This is something which is the result of this decision. Either I sell it. If I sell it, I'll get cash 30,000. If I'm not selling it and I'm giving it to the new machine, I'm losing 30,000. So 30,000 is the number. Material B. So here, what is important that it has no other use. This is what is important. Whether are you using it or not using it. If you are not using it, take the sale price, market selling price. But if you are using it, material B is used regularly by the company and is an inventory at cost of 20,000. I don't care. The cost is passed. It could be sold for 10,000. It could be sold for 10,000 and its current replacement cost is 25. So we have to decide between either 10 or 25. This 20 is past cost. It is gone. Now, if I take this today material and go out, I can sell it for 10K. But the question is, will I sell it for 10K? I need it regularly. The question says it is used regularly. So if you use it regularly, it means if you take out from the inventory, you have to replace it. And the replacement is 25. And that is why I will take 25. Because at my existing warehouse, this material is there. This new machine comes in, I say take out some material and give it there. So when you take out from warehouse and give it to that machine, your warehouse, you need to bring back material again from the market. You have to bring into the inventory and you will go to the market and they will say, oh, that's for 25K. So this is 25K is relevant for you. So let's see the solution. A new machine costs 100K and it will generate some revenue, which is 320. Both are relevant. Both are relevant. Material A, 30,000. This is the price which you can sell it. Material B, 25,000 because this is the replacement. Machine would increase insurance by 3,000. So this is relevant. It would be charged 5%, not relevant because existing costs, existing overheads cannot be charged to the new project because whether you buy this new machine or you don't buy the machine, this 50,000 overheads you are already incurring. These are not the result of buying a new machine. Okay, so this is the answer to this one. And this is actually the same thing. It is repeated again. Future incremental cash flows. We already have discussed this one. Examples of non-relevant cost we discussed. Sunk cost, book cost, depreciation we talked about. What is included? Okay, this is important. An important addition to non-relevant cost. Remember that you might take a loan from a business and you pay interest and that is cash. But remember that you need to ignore all interest payment and all receipts or repayments of capital. So whether you return back the loan or you pay interest on your loan. So when you make your calculation or cash flow calculation, because you will do DCF, you will say my sales revenue is this much, my variable costs are this much, my fixed costs are this much, my tax expenses, this is. So you will calculate what cash comes in, what cash goes out. While making this table, you will ignore interest payment, although you might be paying interest, but you have to ignore it. Or you might be returning back some of your debt, but you have to ignore it at this stage. At this stage. So we ignore these two things, interest payments and capital repayments. Example, the company has to repay the principal on a loan of $20,000 per annum and also incurs annual interest charges of $5,000. So this is two things. Number one, I took a loan of 20,000. I have to pay some interest and I have to pay back some capital. Both of them will be ignored from your table of cash flow calculation for investment appraisal. Although these are cash outflows, but we have to ignore it. Okay. What are the non-relevant examples of this? This is a repetition. We already did this thing before, opportunity cost, working capital. Somehow these slides are duplicated. I will remove them. Then comes the payback period method. This is the first thing we do in the next session.